For decades, corporate accounting contained a structural blind spot. Companies could acquire massive operational assets, fleets of aircraft, national retail networks, industrial machinery, and legally keep the associated financial liabilities entirely off their balance sheets. Two businesses could operate with the exact same asset footprint and generate identical cash flows. Yet, if one company borrowed money to buy its factories and the other signed long-term operating leases, the leasing company would appear significantly less leveraged and far more capital efficient to investors. IFRS 16 eliminates this asymmetry. The regulatory standard forces a single accounting model, treating almost all leased access to assets as a capitalized financing arrangement. When a company commits to a lease, it must now recognize two new line items. First, a right-of-use asset, representing the economic value of controlling the property or equipment. Second, a corresponding lease liability, representing the present value of the future payment obligations. The trigger for this capitalization is no longer finding the word rent in a legal contract. The standard focuses entirely on the economic substance of the arrangement. This chart maps the conceptual foundations of the standard. To translate complex vendor agreements into accurate liabilities, financial controllers must navigate this specific decision logic, moving from off-balance sheet treatment to a model anchored strictly in economic control. Treasury teams must look past the formal wording of an agreement and test whether a contract actually transfers control over an asset and its economic benefits. This framework aligns lessees with borrowers, ensuring that similar economic access to productive assets results in comparable financial reporting across the market. Bypassing this analytical rigor yields severe consequences. Misinterpreting the standard's logic produces materially distorted leverage profiles, misstates capital intensity, and skews the debt covenants that lenders rely on. The accounting process begins with a single threshold question: does a commercial contract actually contain a lease? As illustrated in this graphic, the standard dictates a strict two-pronged test. A lease only exists if the arrangement involves an identified asset and the customer obtains both the economic benefits and the control over how that asset is used. Vendors frequently try to prevent lease classification by inserting clauses that give them the right to substitute the asset. A theoretical right to swap equipment might look like a service arrangement on paper. Under IFRS 16, a substitution right only invalidates a lease if the supplier has the practical operational ability to replace the asset and a clear economic incentive to do so. Both conditions must be met. If a logistics provider can easily swap a generic delivery van from a massive depot to optimize their routes, the substitution right is real. But if the contract involves a customized manufacturing press bolted to a factory floor, swapping it out would be prohibitively expensive. That substitution right lacks economic substance, and the lease remains intact. Once an asset is identified, the lessee must prove they obtain substantially all the primary outputs, byproducts, and overall utility generated by that asset throughout the contract term. There is a sharp distinction between buying a result and controlling a resource. Specifying delivery windows or quality targets means you are purchasing a service. Directing the actual routing, scheduling, and deployment of a dedicated vehicle means you are controlling an asset. Accepting a vendor's managed service label at face value without testing for actual operational control is the primary way companies inadvertently hide material financing obligations within their operating expenses. Recognizing a balance sheet liability for every temporary equipment rental or short-term storage space would paralyze a finance department, generating massive administrative friction for data that investors do not factor into their modeling. To solve this, standard setters introduced specific scope exemptions. As shown on this scale, these rules are explicitly designed to balance conceptual purity against operational feasibility. The first major exemption applies to short-term leases. If the lease term at commencement is 12 months or less, the lessee can elect to keep it off the balance sheet and expense the payments normally. This 12-month test relies on the enforceable lease term, not the nominal date on the contract. If a business faces severe operational disruption or heavy financial penalties for vacating a facility, the economic incentive to stay creates a term that exceeds 1 year, invalidating the exemption. The second exemption covers leases of low-value underlying assets, typically intended to capture basic IT equipment, personal computers, and standard office furniture. This assessment is based on the absolute value of the asset when it is brand new. A heavily used 20-year-old industrial machine with a depressed market price absolutely does not qualify. Furthermore, if a cheap component is highly dependent on or interrelated with a larger complex system, like a specialized network terminal integrated into a multi-million-dollar logistics platform, it loses its standalone low-value status. Regulatory bodies and auditors aggressively scrutinize these boundary cases. They look for patterns of serial renewals, where management strings together repeated short-term contracts for the same asset to intentionally bypass balance sheet recognition. Using scope exemptions as an opportunistic loophole rather than a genuine administrative relief tool violates the core intent of the standard and guarantees regulatory challenge. The final analytical gate requires dissecting complex commercial contracts, where the right to use an asset is bundled with operational support, maintenance, and utility services. Consider a turnkey logistics contract. A company might pay a single monthly fee that covers the exclusive use of a delivery truck, but also includes routine servicing, insurance administration, and fuel management. As this visual breakdown shows, IFRS 16 mandates that these elements must be physically separated. Only the specific portion of the fee paying for the pure asset use right belongs inside the lease measurement model. To execute this, accountants must use relative standalone selling prices. This requires objectively allocating the total contract cost by calculating what the lease and the services would each cost if purchased separately on the open market. The separated lease component capitalizes onto the balance sheet, increasing both the right-of-use asset and the lease liability. The non-lease services bypass the balance sheet entirely, flowing directly to the income statement as operating expenses. The standard does offer a practical expedient, allowing Treasury teams to skip this allocation math and combine all components together to save administrative time. Electing this shortcut carries a severe reporting consequence. It forces raw service expenditures, like cleaning, staffing, and maintenance, directly into the capitalized lease model. This mechanically drives up the reported lease liability, pushing the company's recognized debt far beyond the actual financing obligation tied to the physical asset itself. Indiscriminately applying the non-separation expedient removes service costs from standard operating expenses, which artificially boosts EBITDA while simultaneously inflating leverage. It distorts the firm's true capital structure and misleads investors. When these individual contract decisions aggregate across thousands of agreements, they alter the consolidated presentation of the firm's financial statements. This graph illustrates the shift on the income statement. The traditional flat, straight-line rent expense is entirely replaced by a dual charge of asset depreciation and interest expense on the liability. Because interest accrues on the largest principal balance at the beginning of the term, this new expense structure mechanically front-loads costs in the early years of a lease. It alters reported profit margins, even when actual cash payments to the landlord remain perfectly static. The cash flow statement shifts as well. Operating cash flows suddenly appear healthier because the principal portion of the lease payments has been reclassified downward into financing activities. Lenders, equity analysts, and board members must recognize that an increase in EBITDA, or operating cash flow under this standard, does not represent a genuine economic improvement. It is purely an accounting-driven reallocation. The data output is only as reliable as the inputs. Under-identifying leases hides real leverage, while failing to cleanly separate service components creates phantom debt. Implementing highly sophisticated lease accounting software yields nothing if the initial human judgment regarding economic substance is flawed. Mastering the rigorous decision logic of IFRS 16 is the only reliable way to translate ambiguous legal contracts into a mathematically faithful representation of a corporation's true financial commitments.